The origins, very simply, were in the United States and originate in what they call the subprime element of the mortgage market. That's mortgages to people who have low incomes and find it difficult to document their income in particular. But that's now spread across the world through the financial markets, and the effect in the UK has been very simple. Banks have become very unwilling to lend to each other. They have felt they need to hoard money in the case that people they have lent to want to get their money back. So what's basically happened is banks don't lend to each other, and this has forced up the cost of borrowing in what they call the interbank market. And ultimately for the UK, as will be for European banks as well and the United States, that banks have to pass these increased costs on to somebody. They want to maintain their profit margins, and ultimately that's going to hit retail interest rates as well. Since the middle of last year, the Bank of England has raised interest rates 5 times. This has ultimately passed through into mortgage rates generally. But the key thing is the credit crunch has imposed secondary effects on the mortgage market. Banks have lost money, they want to recoup it somewhere, they're likely to keep mortgage rates higher for longer. The key point for the buy-to-let segment of the market is, given it's the most risky, they're likely to tighten the standards on which they lend most for buy-to-let investors. Well, there are a number of channels at the moment which we believe are driving or pushing down or slowing the growth in average house prices generally. Namely, average house prices now reaching unaffordable territory. This is because incomes have been growing very slowly in the UK, mortgage rates have gone up, and at the same time house price growth has remained strong. So it's becoming more and more difficult for the average person to buy a house. And those mechanisms are going to cause a slowdown in house price growth. But the buy-to-let market has the potential to be sort of an accelerating factor. In particular, if the sort of rental yield mortgage sort of comparison becomes more and more tricky and they don't expect capital growth, they may be forced to put properties on the market, which may effectively accelerate the slowdown in house price growth that is coming just generally through sort of the general channels in the housing market. The idea that property is a good long-run investment is probably very true, in particular in the UK, where we have this 20-30 year problem of a lack of supply of housing, and all the sort of quangos that do work on housing supply and demand all say the same thing, namely that 20-30 years into the future we are still going to have a problem where demand outstrips supply year after year unless more houses are built. So totally agree with the concept that over the long run housing, residential property in the UK remains a very solid investment. But what we're talking about here is a cyclical development, totally different from the sort of long-run structural trend in the housing market. This is a cyclical development where affordability has got too stretched, demand for housing is going to suffer quite a lot, and the demand side correction is going to be what causes house price growth to slow quite markedly.